All right, let's talk about a company that gets a ton of buzz among income investors, AGNC Investment Corp. Now, you might have seen the name around, but there's one giant glaring reason it captures so much attention. And, well, it looks something like this. Yep, that right there. A dividend yield that is consistently in the double digits. We're talking 14%, sometimes even higher. I mean, that is an absolutely eye-watering number, right? Especially when you think about how a typical stock might pay out, what, 1 or 2%, if you're lucky? So, the first question that probably pops into your head is, how on earth is this even possible? And it's not just a yearly thing. AGNC pays this out every single month. How does a company possibly generate enough cash to keep that promise? Well, that's the puzzle we're going to unpack right now.
So, let's dive into part 1, the monthly payout puzzle. This is where we get to the bottom of what makes AGNC just so darn attractive to so many investors looking for income.
You know, the appeal is pretty crystal clear. If your main goal is to generate cash flow from your portfolio, AGNC can look like an absolute dream come true. It's not just that the percentage is high, it's the frequency. Getting a check every single month. That's a predictable, constant stream of cash.
And here is our first huge clue. AGNC isn't just any old company. It's a special type called a real estate investment trust, or a REIT for short. Now here's the kicker. By law, REITs have to pay out at least 90% of their taxable income to shareholders. This isn't just some generous company policy, it's a legal obligation. Okay, so we know why they have to pay out so much money, but where does all that income actually come from? That brings us to our next section. We're going to go inside the MREIT machine and see how it all works. Now, this is a really key distinction. When you hear REIT, you probably think of a company that owns apartment buildings or shopping malls. AGNC is different. It's a mortgage REIT. They don't own the physical property, they own the debt on the property. As the slide says, a great way to think about it is that they're basically in the business of renting money. And this breaks down how they do it beautifully. It's actually a pretty simple concept in 3 steps. Step 1, they borrow massive amounts of money at low short-term interest rates. Step 2, they take that cash and use it to buy assets that pay a higher long-term rate, in this case, mortgage-backed securities. And step 3, the profit, well, that comes from the difference between those 2 rates. That's the magic term right there, the net interest spread. But wait, what are these mortgage-backed securities they're buying? Aren't mortgages risky? That leads us to the next critical piece of this puzzle, the government-backed guarantee. See, AGNC mostly invests in something called agency mortgage-backed securities. That word agency is everything. It means these aren't just any old bundles of home loans. These are mortgages where the principal and the interest payments are actually guaranteed by a U.S. government-sponsored enterprise, like a Fannie Mae or Freddie Mac. And what that really means is AGNC has almost zero credit risk. They don't really have to worry about a homeowner not being able to pay their mortgage, because if they don't, the government agency steps in and makes the payment anyway. So from that angle, their assets look incredibly safe.
Okay, so let's recap. We've got a huge monthly dividend, and it's built on a portfolio of what seem to be super safe, government-guaranteed assets. It sounds a little too good to be true, doesn't it? Which means you have to ask the question, if it's all so safe, where's the catch?
And that brings us to the most important part of this whole explainer, reward versus hidden risks. It's time to flip over that shiny, high-yield coin and take a good, hard look at the other side.
This slide really lays out the trade-off perfectly. On the pro side, you've got exactly what we've been talking about, that huge monthly income and that low credit risk. But then you look at the con side, and you see words like sensitivity, volatility, and leverage risk. Yeah, this is where the simple story gets very, very complicated. Okay, so let's tackle the biggest risk of them all. I want you to picture a seesaw. On one end, you've got the interest rates for the entire economy. When the central bank starts raising rates and that end of the seesaw goes up, the other end of the seesaw, which is the value of all the mortgage bonds AGNC already owns, goes down. Now, why does that happen? It's because any new bonds being sold now have a higher interest rate, which makes the old, lower-rate ones that AGNC holds less valuable. This directly hammers the company's book value, which is just a fancy way of saying what the company's assets are worth. Now, there's another factor here that acts like a massive amplifier on this whole thing: leverage. In simple terms, that just means using borrowed money to invest. And it's an incredibly powerful tool. It's what allows AGNC to turn what would be a small profit on their interest rate spread into a huge win for their shareholders. But it is a brutal, double-edged sword, because that exact same leverage also turns a small loss, like the one from rising interest rates we just talked about, into a potentially disastrous one. Leverage magnifies everything, for better and for worse.
And all of this risk leads to one critical point. The source material is very clear about this, and you have to understand it. That beautiful high-yield dividend is not guaranteed. In fact, it has been cut, and cut significantly, multiple times in the past when the market, especially interest rates, turned against them. So what that means is investors cannot and should not rely on it staying the same.
So with all that on the table, we get to our final section. Is this income play for you? This is really about taking everything we've just learned and figuring out if and how it might fit into your own personal investment strategy.
This slide really helps you frame the decision. You have to ask yourself some honest questions. Is your number one priority that monthly cash flow? And are you okay with major swings in the stock's price to get it? Or are you someone who's looking for the value of your investment to grow steadily over the long term? AGNC is a tool built for that first person, not the second. It's an income play, but a very, very volatile one.
And of course, we have to put up this crucial reminder. This explainer is for educational and informational purposes only. It is absolutely not financial advice. The world of MREITs is incredibly complex, so please, always do your own deep dive research or talk to a qualified professional.
So we'll leave you with this one final thought. At its core, AGNC represents a fundamental trade-off, and it asks every potential investor a very direct question. Is the allure of that big monthly paycheck worth the stomach-churning volatility of riding a market seesaw? Well, the answer to that depends entirely on you.